For example, if you own your business, there is ESOPs, which are the primary way that shares are sold into a trust that is owned by the workers, and that way you get employee ownership. This may or may not come with democracy, workplace democracy, depending on how much control the workers actually have over that trust and how much control that trust has over the election of directors. And there's also 1042 rollovers. And both of these mechanisms give tax breaks to the current owners of the business when they sell it to the employees. So basically, if you own your own business, you can get some nice tax breaks when you sell it to your employees. But this talk is not so much about that. This is if you're an employee at a business and say the owner doesn't want to sell and you want to maybe be at a worker co-op, there's two options. One, you could start your own. There's several impediments to doing that. Or two, you could try to convert your business to a worker co-op. And so that'll be the topic of this talk here. I'm going to give a little bit of background about labor rights and modern finance in order to understand how these conversions take place. So I'm going to back up and diverge a little bit and talk about human rentals. And that'll give some labor rights context to why, since this is a little bit controversial, of why employees might want to take over their own business. So today, when we think of employment, what we're really talking about is the voluntary self-rental. We're renting ourselves in exchange for a salary or wage. And there's a long history of questioning certain types of contracts, including willful voluntary contracts. For example, in a political democracy, if I want to sell you my vote and you want to pay me, maybe you really need the money for health care or food, that transaction is prohibited. And it's prohibited in a political democracy because that would be looked at as a contract of alienation, where you're alienating your right to self-governance, not delegating it. For example, voting for representatives. So we can see there's precedent for prohibiting certain voluntary willful contracts, and in fact, the renting of votes in a democracy is also prohibited. So there's this idea that you can self-govern, but you can't alienate that right to self-governance. And the question is, what about at work? Can you do this at work? And it was understood that the slavery contract was a contract of alienation. You lose certain fundamental rights when you sell your labor, and that's true whether you're selling it or renting it. So the whole idea that there's this employment contract and the whole economy is built on the renting of humans, basically employment, and the problem is too much employment, not unemployment, so to speak, is the basic labor relationship in fact valid? And this has also been traced through the women's rights argument. For example, women's suffrage, basically that women are in fact people and they have certain rights to vote, which happened, probably a century and a half into the US history after a great war for democracy, when women had to protest and say, well, the US isn't a democracy even though we're fighting for it elsewhere because half our population doesn't vote. So there is some train of thought from the Enlightenment which says there are problems with human contracts of alienation, the selling of votes, the renting of votes, the prohibition of women voting, the coverture marriage contract when women became the property of the husband. All of these things have been abolished, and these are the major social progresses today. So that's the context and background for why we're talking about how do we get from where we are here to worker cooperatives where people have a right over the profits and losses of the business and can self-govern. It's governed by the business is governed by the workers. So getting back to, let's say you're an employee at a business, and here we're talking about a large publicly traded business that has either issued equity or debt. Now, if you're at one of these businesses and there's, say, maybe an antagonistic relationship with management, what do you do about it? Because in that case, if you're at a profitable business, first of all, the owner is unlikely to sell. So most of the conversions that take place today are either one large ESOPs or two small family-run businesses that, when the owners are retiring, decide to sell the business to their workers. And And that's okay if the owner's willing to sell, but short of convincing the owner, what do? Now, today, when we look at a business and how it's valued, there's a market value of all publicly traded businesses, privately traded businesses too. And that market value is based on the expected earnings, the future earnings of that firm, discounted to the present. So the way they come, in theory, to a price is they say, what do we expect the earnings to be going forward? And what is that future stream of earnings worth today? And that assumes that today you can earn all the future profits, you have the right to all the future profits of the business. Now, of course, in a worker cooperative, that can't possibly be true, because in a worker cooperative, the future workers at any given time have the rights to those profits. So you can't today, in a worker cooperative, own the future profits of the business. So that's the main distinction in the valuation. There's a net asset value of a worker cooperative. The cooperative owns assets, it has liabilities. That difference is the net asset value. And for a non-cooperative business, there's a market value. All the future profits owned today. Now, if you're trying to convert your business, one way to do it is to just buy it outright. You pay the market value of the business, which means you pay for all the future profits you're going to make for forever up front today, which are, of course, profits coming from your own labor. So that's a transaction of zero financial benefit under the condition that you stay with the business indefinitely and actually appropriate all those profits. And of course, negative benefit if you leave. So the question is, why should a worker pay for their future profits from their own labor? We could ask, by analogy, a similar question in the case of slavery. Let's say you're trying to convert a slave plantation into a worker cooperative. If you expected the slaves to buy the plantation, should they pay for their own value? Should they pay for the value of the slaves that the plantation owned? Is that the right way to do it? Or is there some reason that the value of slaves should be identically equal to zero? Say, ownership of humans was somehow invalid. So, since the valuations are different and the principles are different, the question is, how do we get the transition from a business today that is not owned by the workers to the workers, but not pay the market value, because that value is not the right value? So the key thing in this is that the value of a business today depends on the future profits. And you can only have future profits if you have people doing work. So if nobody's doing work in the business, you have an asset holding company. And the value of any asset holding company is the net asset value. It's the value of the assets minus the value of the liabilities. So today when we think of sort of labor rights, usually people think of strikes. And the strike is always, well, you quit temporarily, but you always plan to go back to work. Maybe with higher benefits or something like that. But you're still renting yourself out. You're still basically doing work, and the profits are going to somebody else. And that's been one of the flaws of how the labor movement has thought about organizing, is that they always want to strike to go back to work, not to actually gain control of their own business. Now, two things happen if the workers decide to stop working, but not strike, but just quit. If all the workers of a business quit, the value of that business goes from the current market value, basically all the future profits discounted to the present, to the net asset value. So you have a collapse in the price of the business if there are no employees. And that's true because a firm with no employees can't produce any profit other than renting out the assets of the business, and that is the value of the assets. So here we can see how the workers can manipulate the price of their business in such a way that they might potentially profit from it. Now, in modern finance, they give you a number of ways to profit from the change in price of a business. One, you can short sell shares of the business. The transaction is basically you borrow shares, you sell them, you hope the price drops, and you buy them back at a cheaper price, and you make that difference in the price. That's one way that people profit from declining share value. The second way they do that is they can purchase options. There's an option called a put, which allows you to sell shares to somebody at a certain price for a certain period of time. It's the right to do this, not the obligation. So for example, if the share dropped in value, you might have the right to sell them those shares at a higher price than the current value of the stock. So we'll talk about these two first. So if all the workers of a business organized to, say, quit simultaneously and had already purchased, say, puts on the shares of the business, this would allow them to profit in a leveraged way where they would not have to take a lot of risk or have a lot of upfront capital, which are the two main impediments to starting their own business. And the idea was that the workers would use the proceeds from this transaction to not do a straight conversion, but to form their own business doing exactly the same thing. And this would have the advantages of, one, you have already a trained workforce who knows how to work together. If you are competing against the pre-existing company, they have to train a whole new workforce basically from scratch. Two, you can use the proceeds of these transactions to buy the assets that you need to start your business. You can also use them to fund the workers during that transition period. And when you use options, which are the best way to do this, options are highly leveraged. So if you buy options that are close to the value of the company, that when it currently has employees, you make a large multiple of the price you paid for that business. So today, for most profitable companies, say if you look at the stock market, the current market value is probably 3 or 4 times the book value, the net asset value of the business. So what you're looking at is probably 75-ish% declines in the price of the business, where your profit off of the puts is something proportional to, say, if it's, call it a 10% cost to purchase the put, you're making now 6-7-fold on this investment, which is more than enough to start the new business. So the workers can do this with very little upfront capital. They could use a very leveraged transaction, and they could get these funds to purchase the assets which they need to run the business. Now, that's one way to do it, which has very limited risk. The other way to do it is to short sell the stock, basically borrow the stock, and then hope to buy it back at a lower price. In that transaction, you get basically the price difference of the stock. So both of these ways provide a very large amount of money to purchase the assets you need and to fund this transition. And the question is, can this happen in practice, and what are the barriers? And there are a number of impediments, but the basic transaction is very simple and straightforward, and probably simple for any organized group of workers to carry out. The only issue is probably a securities law issue of insider trading, and this can be circumvented by publishing what you're going to do in a very small local print-only paper. Then it's public information, and you can proceed. So I'm going to break here and see if there's any questions.
Yeah. I'm just curious, has this ever been done yet, or is it
This has never been tried. So this is, in theory, how a group of workers might convert their business. And here we're talking about large businesses. So basically businesses that are publicly traded that you can either trade options on or short sell. And there is another way to do this also with credit default swaps. So a credit default swap it's called a derivative, but it's really insurance. It's insurance against defaults. In this case, the default of a company's bonds. So when companies issue debt, basically they say, we'll make this stream of payments in the future. And the credit default says, well, if they fail to do that, we'll pay you the value of the bond. And so you pay a premium for this type of insurance. So in the case, say there's large large private company which doesn't issue equity but has outstanding debt, the workers might also purchase credit default swaps, simultaneously quit. If there's no future stream of income, it's very hard to make the required payments, assuming there's not a huge amount of liquidity in the business. And the credit default is also very highly leveraged, so this provides the funds to do the transition to the workplace.
So I like the theory of this. It's very swashbuckly. But I see two major barriers, which is one, your personnel structures, like getting you say it's very low risk, and I think that's a defined term because I see a high amount of human risk. You'd have to have a highly aligned group that had a lot of trust mechanisms built in, not just culturally but legally speaking, because what's to prevent half the workforce from taking the profits from their leveraged swap and absconding with them? And then the business, then the 3/4 of the people who stay don't have the assets to leverage the business and aren't able to complete the conversion, lose their job, and we lose net worker empowerment. Like that's
Sure.
like that would, I can see that being a big barrier to this actually happening in practice. But it seems like a possibly solvable barrier. What legal structures and agreements could you come up with to circumvent that possibility? I mean, the trust thing you can work on. It's a thing you can work on, but with that amount of money involved, I would hesitate to trust in human goodness rather than some structure.
Right, and there is the question of would this be all the workers sort of, agreeing and then doing it independently, or would there be some central organization to do this?
Right, like would they do it through an umbrella organization,
right,
or how?
A union or whatnot.
Right, and would that
So,
even be able to purchase these things?
Well, I think
standing and status and all that stuff.
Well, I think the purchase, so I think the actual transaction, the financial transaction is very straightforward. So anybody can go purchase derivatives. And it's a question of whether each individual employee decides to go purchase them on their own and then pull their assets afterward or not. And in fact, when you're this highly leveraged, you probably don't even need everybody on board. But for the sake of solidarity, you probably need a pretty large majority. And also, if you want to set up a business and get going quickly, you need most of the people. So it's a big organizing challenge, but it's a very different organizing challenge than what we currently think of when, say, healthcare workers strike or something. And there is the issue of worker solidarity and community solidarity, because with any business, there's contracts which have to be shifted over. There's issues like that. And in some cases, there are either intellectual property issues which would prevent this from happening, or real estate issues, because if they don't want to sell the real estate, and that's the key part of it, then you're out of luck. So this isn't sort of a blanket, anybody can do this, but it's a way where a lot of businesses could potentially do it. And more so than that, it's a way that the workers actually have the leverage, because usually workers are at the short end of the bargaining table. And the reality is the workers have all the power. If they refuse to work, then everything stops. So, and they could refuse to work in ways which help them actually get some sovereignty. Yes.
Since most, as far as I can see, most publicly traded companies are huge. I mean, thousands of employees. Sort of echoing what Kate said, it just seems like getting enough people on board quickly enough would be a major stumbling block.
Yeah, well, it doesn't have to be quickly is the answer. It could take however long it needs. The question is when you engage in the financial transaction. I think that's when you have a critical mass of people. So the point is that you don't start by purchasing derivatives or short selling the stock. You start by organizing and coming to agreement that we all want to run our own business, the same business, and own it. And after that takes place, then you enter into these financial transactions after it's been disclosed. And most likely the organizing won't be a complete secret anyway at this scale. So. And there are questions of what happens to the price of the business when that knowledge does seep out. Do people still think they're going to keep getting the future profits, or will the price plummet? But it is a way to get very profitable companies, and that's usually the opposite of what happens now, is that the conversions are struggling companies in dying industries that are, for one reason or another, not viable. And we have no way right now to get sort of the profitable companies in strategic sectors, which are of more interest to the movement. So this gets at that a little bit.
The workers' rights movement.
The workers' rights movement.
I have kind of I'm not sure if this is theoretical or esoteric or what, but so working in a small, boss-oriented, command and control style business versus working in a small, cooperative, collectively empowered business, there's a real qualitative difference in the worker life, right? Like the lived hours are in your workspace is a very qualitative difference that I think is like the essence of that not renting yourself out bullshit that we were speaking of earlier. How different would it be at the scale of 1,000 people? Like, would the representative democracy experience that is probably necessary at that scale have a sufficiently different impact on the human to justify all of this change?
That would depend on how it's organized and the culture of that specific business. So
Yeah.
I probably can't make a general statement about that.
Do you think it would change it a lot?
I think it would depend on the specific implementation. So, and that may take some time. And, I mean, there's culture that has to be built and all sorts of things. So I don't really know. So perhaps
Several.
I could give one other slavery analogy, because this is sort of the easy analogy to understand the transaction that's taking place. So let's pretend for a second that we had a slave market, a couple hundred years ago, where slaves were bought and sold, but with modern finance, so slavery with derivatives and equity. And let's assume for a second that an individual slave might have shares outstanding on their person, and whoever owned those shares would have the right to the profit from that slave's labor. And the slave could be owned outright by one person or one entity, or in piecemeal, which is more or less the corporate structure today. So if that was the situation, and if, say, you thought slavery was wrong, maybe it should be abolished, but you wanted to help the slaves free themselves, well, how would you do it? Well, there's a few ways. One, you could have the slave pay for themselves and free themselves. Basically, they could pay for their value. They could pay for the profits that would be derived from their lifetime of labor. That's one way slaves might be freed. And so you could raise funds and help slaves purchase their freedom. But there's another way to do it, which is if the slave was able to purchase options on their own equity and profit from a decline in their own value, that might be a way a slave could finance their own freedom. For example, if you were allowed to, say, purchase puts on shares of yourself, if you were a slave, and if those shares declined, say you suddenly refused to work, and there were not going to be any future profits from your labor, your profits would be large enough from that transaction to purchase your own freedom, which would be a way under modern finance with slavery that slaves might be free. This is the almost exact analog of that scenario, where today, when you rent yourself, somebody else owns all your profits and all the profits of that business. Those profits can disappear if the workers quit in the same way. And the same valuation applies, just like a slave may be valued on their strength and work ethic and agreeableness and all sorts of factors. Well, that goes into the value of the slave. All of that profit, all the value of the slave collapses the second the slave refuses to work. And the same collapse happens in the market value of a business when the employees refuse to work, just the same way a slave can refuse to work. And that exact same transaction takes place. And that right there is the essence of modern finance and modern capitalism, is the renting of humans and the monetization of human labor and the profits from human labor today. And it's done with equity in the stock market in the same way it was done with slave trading a few hundred years ago. So if you can understand the slave case, you can understand exactly how the modern economy works with equal legitimacy, but you also know how to break it.